So we move to Chapter 11, Accruals, Prepayments, Accrued Income, and Deferred Income. Now this area and this chapter I would probably place reasonably high up, certainly not quite in the latter 50% of chapters, certainly in the first 50. And the reason for that is that the adjustments, the double entry relating to this particular area does tend to cause students a little bit of difficulty. So we need to spend some time on it because the examiner will in the exam. I expect questions on this area for sure. Let's start with section 1, the concepts. So, the accrual concept and the matching concept. Now, outside of your review of the chapter, I'm hoping that you may have come across this concept in some way, shape or form in prior studies. In terms of this particular concept of an accrual or accruals, really we're talking about the timing of the recognition of transactions. Okay, now if you've been through the chapter and indeed you're listening to me now, maybe it still doesn't make a great deal of sense, but certainly give me 5 to 10 minutes in it. Well, so when we say timing, what we mean is that under the accruals basis, revenue and costs are both accrued or recognized as earned or incurred and recorded in the financial statements in the period that they relate. Okay, so really, rather than recording them in another period, we must be able to, in effect, match revenues and costs to the right period. And in essence, that's what the accrual and the matching concept are all about. If we take a look at this diagram that I've sort of cut and pasted out, now there's quite a lot in here and we'll be going through each of these areas in this particular video. But if we open up what we mean by this accrual accounting and how the essence of timing comes into play, let's talk firstly, let's say, about an expense paid in advance. Okay, now this is similar, but I guess in one sense in reverse. We're talking about a prepaid expense. So in terms of timing, I've paid it now, but in terms of the period, remember what we said, the period that they relate, really that period is out of sync. So in effect, I have prepaid an expense. I now have in my accounts what is known as a prepayment, and we'll be looking closely at the double entry to allow for that. Okay, now what about the next one here? Expense incurred but not invoiced or paid. Now this is very much in line with what we said up top, but certainly prepayments are in line too, but just to use the terminology that we had just been using on the intro. So what's happening here? Well, we need to, I guess, accrue for this expense, because we haven't paid it. It's not been invoiced, for example, let's say by the electricity company or the rates company. So we need to accrue for it. So this would be an accrued expense. In effect, again, getting back to our timing point, we've used it, but we haven't paid for it, and it certainly hasn't been invoiced. What about the next area here? It says, income earned, but not invoiced or paid. So we're saying that in effect here we have what's called accrued income. In other words, it seems that we've earned some income, but we haven't actually raised a sales invoice and or it hasn't been paid yet. So that's what's referred to as accrued income. Again, each of these concepts, prepayment, accrued expense, accrued income, will be opened up in this particular mind map. What about this last one, income received in advance? Okay, now that sounds slightly unusual, but it happens. In other words, we've had income received, but in fact, in terms of timing, it actually relates to a later period. So that's referred to as deferred income. Remember, matching. We want to match costs and indeed revenues with the period that they relate. So each of these 4 areas in a different way hinges on that concept of accrual accounting. Okay? So let's open up some of these areas a little bit more. In terms of, applying the accrual concept, I'll just show you the diagram. I'm sure you've seen this already, obviously. What's it applied to? Well, the areas that we saw above. In terms of the double entry, we have it on the right-hand side. I'll come to that in a second. But, those are the four areas that we've just walked through. And indeed, these are the explanations. So just one more time as an example. Let's say prepayments. What's that again? Well, payments made before expenses incurred. Oh, well, I've paid a rates bill early in this year. And indeed, it actually relates to my next financial year. That's a prepayment. I need to do something about that. In fact, it's an asset, isn't it? Because technically that company, let's say the rates provider or the local authority, sort of owes me money because I paid in advance. What about, let's say, deferred income? Well, as we saw up top, we see that that's a payment received before the income is earned. Now, technically, yes, it's income, but actually it's been received well in advance. So strictly speaking, from a timing perspective, that income is not relevant to this financial year. It's actually a liability in one sense, although that may seem a little bit odd given that it's income. But in essence, it's a liability that will roll forward next year into income when it will be matched and will be correctly timed. Now, in terms of the double entry, really, the double entry is not overly complicated, to be honest. I mean, if we think about an accruals payment, as we've said, this is expenses incurred before payments made, or perhaps we receive an invoice. So technically, that's a liability. So what do we need to do? Well, we certainly need to create the expense, debit expenses to increase them. We'll recall from our double entry rule. And credit accruals, which is a liability account. So remember, this hasn't been invoiced, it hasn't been paid, but we need to include this expense in our account. It might be electricity, rates, etc., etc. So there it is. The expense has been increased, the liability has been increased. We're good to go. What about prepayments? Well, as we've just said, this prepayment is an asset. So let's set it up as an asset. Let's increase assets under the banner of current assets. And indeed, let's reduce the expense. Why reduce the expense? Because when we incurred the payment, we debited that payment to the expenses. So for example, we paid electricity in advance, we paid rent in advance. In effect, that expense is top heavy. It's got too much in it. So we must remove the expense element that relates to next year, the prepayment, move it into prepayment. So create the asset, reduce the expense. In terms of accrued income, you remember income earned before payment received. And technically, note, that is an asset, okay? So how do we create that asset? And indeed, how do we allow for the income side? Well, technically what we need to do is to debit accrued income, i.e. that asset account, and indeed credit income in the P&L account. We must increase income because we've earned income before payment received. So payment will be due to offset against that debtor in effect, and indeed we've correctly transacted in relation to the income side. For deferred income, it's a little bit like the opposite of what we've just talked about in terms of accrued income. What is it again? Well, payment has been received from Joe Bloggs, for example, before the income's actually earned. So really, we've recorded income that shouldn't be recorded. So what do? Let's reduce income, or let's create, in effect, the liability, debit income, and credit deferred income, i.e. this liability. Now, there's a lot of information in there, particularly in the last two areas in terms of logic, understanding, and comprehension. I understand that. Remember, as we said before, we take things bit by bit. We're not trying to understand every single thing the first time we read it, possibly not even the second time or the third time. We're just trying to get a feel for the concepts, okay? So we'll open this up further in a moment as we flow through. So in terms of accruals specifically, let's focus in on them. Again, what is an accrual? Well, as we've said, this accrual, whatever it is, it's recognized when an expense is incurred, has not been paid or invoiced for by the end of the financial period. So the scenario is this. We have 31st of December, year end. We know that we have incurred significant electricity costs, but for the last quarter, the last 3 months, October, November and December, we haven't actually received our electricity bill. So let's accrue for it. Let's recognize this expense now. We know the invoice will come in due course, but we've got to put it into the accounts. So let's debit expense, electricity or heat and light, and let's credit accruals. There we have it. Our accounts are now good and pucker. Now, in terms of accounting, as I've just been through the double entry there, let's consolidate on it. We're going to have a variety of different accruals, not just heat and light, I can assure you of that, certainly in my experience of doing accounts. So in terms of the impact, this is the double entry as just touched on in relation to the example for heat and light or electricity. At the end of the day, we have to increase the expense because it's an expense that's been incurred. We have no invoice, we haven't made any payment. We also have to increase our liabilities, in effect, our accruals account. So this whole area of creating an accrual, whatever it is, has to be centered around increasing expenses, therefore debit. Increasing liability, therefore credit. And there you have it. Now, we're not done yet, because that adjustment, that journal entry at the end of the financial period, perhaps the beginning of the following because we're doing the accounts, needs to be followed through on. Now, what do I mean by that? Well, what I mean is that in the next accounting period, what we have to do, because we're expecting an electricity invoice, we actually have to revisit this area. We have to reverse the accrual. We can't just leave it where it is. More of that in a moment, but how do we reverse it? Well, let's reverse it first and then let's look at the second adjustment. Well, to reverse it, we simply do the reverse entry that we did up top. We debit accruals, i.e. we reduce the liability, and we credit the individual expense, i.e. we decrease the expense. Now, why do we do that? I'll tell you why we do it, because bottom line is that invoice is just about to arrive. We need to reverse this accrual entry at the end of the previous period. Otherwise, we're going to have a double count. We are going to have a double count. So this entry number 2, is simply backing out the entry up top. Then what happens? Well, we then get the electricity bill and we pay it. What happens then? Well, we increase the expense. We debit expense. Expense is recorded, increase, and we credit bank, i.e. reduce asset. So you'll see that in effect, these two journals, this one here, and indeed this one here, will back each other out in one sense, won't they? In other words, there'll be no difference to our accounts because they will cancel. Okay? So this next accounting period adjustment is essential. We can't just do what we did here. We can't just create the accrual at the end of the financial period and walk away. Otherwise, we're going to end up in a position where we have a double count. Okay? We'll have the initial accrual entry, i.e. the journal to record the accrual, and then on top of that, we'll have the invoice as well. Okay? Hope that makes sense. Let's talk a little bit about prepayments now. Now, you remember what we said up top. A prepayment is essentially a transaction where it's recognized that a business pays in the current financial period for an expense that relates to the next financial period. In effect, It's a prepaid expense, or to use the phrase here per the study text, a payment in advance. Okay? Now, that goes against, as you'd expect, the matching concept, because that means that we've, in effect, included in our accounts this year an expense that doesn't relate to it. So we have to make an adjustment for prepayment. Creation is made credit, reduces expenses. In effect, what we do is we sort of create a debtor. Yeah, we create this asset called prepayments. Where does it go? Under current assets, certainly short term, maybe less than 30 days. So this prepayment is in effect setting up ourselves for the forthcoming period. We create this asset that in effect we're owed money by the electricity company. We paid in advance. We shouldn't have paid in advance. We did. And then outside of that, we credit the individual expense account. Now, why do we do that? Because originally, when we made this payment, in advance, we debited the expense account. So we overloaded the profit and loss account. We overloaded, let's say, electricity or heat and light costs with an expense that doesn't relate to this period. So therefore, we must reduce the expense, credit expenses to reduce them. Now note, as before on the other side of the page, where we're in a position where the business continues using the expenses in the next accounting period, it has to adjust for the prepayment reversal for the same reasons that we saw in relation to the accrual. Firstly, let me show you how we do that, and let me explain a little bit further. Well, it seems to me that the reversal of the payment is just this journal turned on its head. We debit the individual expenses have increased, and we credit the prepayment account, in effect bringing that prepayment expense into individual profit and loss account. Okay? Now, there's quite a lot of information for you, I understand. In terms of getting to the bottom of it, getting to the logic of it, again, you're probably sick of listening to me, but the only way, if it's confusing, and maybe it's not, but if it is, the only way to do it is slowly walk through questions of that style. I would suggest do them, get them wrong, and then brush up once by looking at the model solutions. Now, the next areas for us are this area of accrued and deferred income. Let's firstly deal with accrued income. Accrued income is recognized when a business receives its income in arrears after earning it. So, in this case, at year end, the business has earned income that has not been received. Okay? Now, the flip side of that is what we refer to as deferred income. So, deferred income, note, recognized when a business receives its income before earning it. At year end, the business received a payment related to the following year. So if I just go back a little bit and just remind you, one's going one way, and the other's going the other way. Here, when a business receives its income in arrears after earning it, and the other, as we've just said, receives its income before earning it. Now we'll see as we walk down the double entries that there's a particular approach indeed to dealing with each of these different types of income. In the first instance, accrued income. Let's deal with that, okay? Now, if we look at the double entry, what we see here is that we have entries into an asset account, accrued income, asset, and we have an entry into individual income or increasing income. So it seems to me what we're doing here in one sense is sort of creating a debtor and creating income. We're creating this asset, because in effect we want to include this income, which hasn't been invoiced yet, in our accounts. So let's increase asset by debiting it. The account is called accrued income in current assets. And let's create some income by crediting. Remember our double entry rule, credit income and liabilities to increase them. Okay, so there we have it. We have now, in effect, accrued income for the year. Let's move on to this next area. Now, note, income calculated for the current year where payment has not been received is recognized as an asset. Let's be very, very clear on that. It can get confusing given that we're using the sort of same sorts of terms or terminology as we are with expenses, accrued, etc., etc. But let's recognize here what we have is not a liability like accrued expenses. We have an asset, accrued income, the reverse in effect. Now, in terms of the next period, again, as we saw previously, note that in the next period where payment has been received, the business will reverse the accrued income adjustment made in the previous period and record the income receipt. Now, again, very much like we saw on the accrual side, just because we've set up this accrued income adjustment here doesn't mean that we simply just leave it and walk away, because we know that we're going to invoice in the forthcoming period. So this is what we have to do. First things first, let's simply reverse the adjustment that we made up top. This first entry is just simply the entry up top, back to front. We debit the individual income account. So we decrease income. And we credit the asset account, accrued income account. We reduce the asset. So that entry has now gone. What then happens? Well, this is going to happen, and we knew it was going to happen. Here comes the income. What do? Well, the income is coming into the bank account. We debit bank to increase bank. And we credit, again, the individual income account, the income account. So here you'll see that these will offset against each other. So in effect, the net effect will be 0. Okay? So in terms of sort of deciphering that, again, as I've said, we'll touch on the deferred income in a moment, but accrued income, I would say, is certainly one of the more complex areas in the syllabus alongside deferred income. I think accrued expenses and prepayments are much more straightforward. So if you're having a little bit of difficulty, understand. If you're perfectly good with it, that's great too. So in terms of deferred income, or if you will, prepaid income, at the year end, the business will adjust for deferred or prepaid income for income generated for payments in advance. Okay? So in terms of where we are with the double entry, well, we would have a situation where, in effect, we'd have income coming into the bank account. We'd be increasing the asset. And we, at the same time, would be increasing our income. This is income that's come in. What do? Well, we record it in the normal way. We record the income receipt. We can't do anything more than that. But at the end of the day, we have an issue because of our definition, obviously, of what deferred income actually is. It's income in advance. We need to adjust for this deferred income creation. How do we do that? Well, we cannot allow this income just to sit within income. We need to move it. So let's reduce income and let's create a liability, because technically this amount is a liability due to come into play in the following financial year. So in effect, debit individual income account, decrease income, and credit deferred income, this liability, in effect a liability for the forthcoming period. Now in terms of moving from there, obviously note that as the months progress, as we saw over on the right hand side, the business will generate income in the following accounting period. Accordingly, it will record the deferred income reversal. Now, what does that mean? Well, it simply means to adjust the final entry that we just did. How do I do that? Well, get rid of the deferred income account, i.e. this one here. We created this liability and we said we've got to do this because this income is relevant to the next accounting period. We credited deferred income. Now, what do? Well, I need to get rid of it. Debit it. Therefore, it's gone. And in terms of the entry, credit individual income. So income has then increased. The income is now in the right period, as opposed to being a liability waiting to be used up. Okay? So, in terms of this particular chapter, I'd say several things about it. The first one is that the basic level stuff here is going to get examined, absolutely, accruals and prepayments. This is certainly, as mentioned from the off, our bread and butter, our cheap marks. There's definitely going to be accruals and prepayments questions in your exam. You know, in terms of the other side, accrued income and deferred income, it's a little bit more tricky because of the reversals, etc., and also because of the concepts, but it is included in our syllabus. So we need to be savvy with it. Will there be lots and lots and lots of questions on these two areas? No, there won't be. And, you know, if you don't believe me, check exams. You know, look how many questions are relevant to this chapter. You'll see certainly more on accruals and prepayments than you will on accrued and deferred income for sure. Okay, so we're making progress step by step, little by little. Please do keep working hard, and good luck with your studies.